Stop paying extra for your home loan. The Reserve Bank of India just made a decision that would be quietly adding years and lakhs to your debt. If you're planning to buy a house or already a home loaner, stick around because this is going to save you a lot of money.
On 5th of December 2025, RBI has cut a repo rate by 25 basis points, bringing it down to 5.25%. This marks a total reduction of 125 basis points this year alone. Think of the repo rate as a fundamental price of money in our economy. It's the rate at which RBI lends money to all the commercial banks like HDFC, SBI, ICICI, usually for shorter periods.
When the RBI raises the repo rate, it means banks have to pay more to borrow money. When the RBI cuts it, banks pay less. Simple, right?
The critical point is this: your bank's borrowing cost is their base cost. Any change here must be passed on to the final customer. That's you, the home loan borrower. Before 2019, this link was murky, but now all banks must link their floating rate home loans to an external benchmark lending rate or EBLR. In 99% of the cases, that benchmark is the RBI's own repo rate.
This means your final rate is repo rate plus spread. Spread is simply the bank's profit margin. So whenever the repo rate changes, it triggers an automatic and mandatory adjustments to your loan's interest rate.
This isn't a theoretical economics. This is the financial weather forecast. The RBI has moved the repo rate dramatically over the years to manage inflation and growth. Historically, we have seen high points like in 2011 when the rate went over 8% to fight high inflation, leading to massive EMIs. Conversely, during the COVID 19 pandemic slowdown, the RBI brought the rate down to a historic low of 4% to inject liquidity and encourage borrowing.
Then look at the recent hiking cycle where RBI quickly moved the repo rate from 4% to 6.5%. For a rupees 50 lakh borrower, this period would have been an interest rate tsunami.
When the rates rise, your bank often doesn't cut your EMI to soften the blow. Instead, they secretly add 3, 4, or even 5 years to your loan tenure. A 15-year loan silently becomes a 20-year loan. That's why you must always pay attention to the rate cuts.
Let's get into the important part of this video. What you can do when the repo rate changes. You have a four powerful strategies to control your own. The banks won't automatically offer you the best one, but you have to demand for it.
Strategy 1: reduce your EMI amount. This is the most common and simplest action. When the rate drops, your bank reduces your monthly payment, keeping the original loan tenure intact. This is great for improving your monthly cash flows.
Strategy 2. Reduce your loan tenure. This is always the smarter choice financially. Ask your bank to keep your EMI amount roughly the same, but use the benefit of lower interest rate to aggressively cut down your loan duration. This is going to save you a maximum of interest over the long run.
Strategy 3: partial prepayment. Regardless of a rate cut, making even a small lump sum prepayment or increasing your EMI every year is the most effective way to beat the bank. Use any surplus funds, like bonuses, to clear a chunk of the principal amount. This directly saves you future interest.
If your bank is not ready to pass on the rate cut benefit, or if you have signed the loan when the rates were very high, it's time to switch. Don't be loyal to a bad deal.
Transferring your outstanding loan to a new bank offering a significantly better interest rate, even after factoring in processing fees, can result in massive savings.
Repo rate is not a piece of abstract economic theory, but it is a direct control panel for your biggest long term debt. Now you know the mechanism and the four key actions too. If you found this video useful, hit a like button and please do subscribe to my channel.